So the last step in making sure that you have an optimized portfolio is obviously to consider how you're going to get more money into your business, into this investment scheme of yours. Now, obviously, how much weight you give to this would depend how much cash you have available to yourself. So to be honest with you, as I mentioned before, the three spheres being asset protection, tax efficiency, and financing optimization have to find a sweet balance between each other. There has to be equilibrium. And the financing optimization, usually what you find is people that are very cash rich, or it's very cash heavy investment environment, they often tend to give this far less attention because they've got the means to be able to fund their investments. But for the usual investor and for the very aspirant investor who's investing quite aggressively, you are going to run out of money, right? And one of the tricks that we normally find in the investment space is I would rather you say 10 million Rand and invest in 10 properties by putting 1 million Rand into each property as opposed to buying one property for 10 million. But that's just me. But you'll find that this notion is followed by many, many investors because you get to hedge your risks and sometimes you get to compound your returns because now you've got 10 properties you're paying off, and when they're all paid off, as an example, now you're getting 10 rental incomes. But obviously investment strategy is something completely different. From my perspective, we need to look at how to financially optimize your investment structure. First little thing that we need to clarify is there's two types of financing structures. The first type is capital, second type is debt. So what's capital? Capital is when you put your own money into the investment. So again, cash-heavy investors use their own money. That's contributing capital towards an investment or towards a company. But that's not the only way to get capital. Other people can invest their money into your investment, right? That's also a capital injection into your investment. But what does this mean for you as an investor? Well, guess what? Now you've got business partners, right? So although capital contributions are great because everyone carries the same risk, you have to remember everyone now carries the same upside. So if you're running at a loss, the good news is that your co-investor would typically also be running at a loss. But if you're running with great profits, your co-investor would be able to benefit from these as well. So you share your downside, but you share your upside as well. And in a business venture, there's always a good time to use a capital injection. Very often you find that that's at the beginning of the business venture, because at that moment you don't know what your risk is going to be. And because you want to carry this risk with somebody else, sometimes starting with somebody else is a very good idea, as opposed to, for example, running a very successful property portfolio and now bringing on and invest into a current property portfolio where they get to benefit from the upsides of all the work that you've put in. So capital contributions are very typically found at the beginning of a journey. Also, bear in mind that capital contributions are where people get a good upside. They're also usually more willing to take higher risks. So they invest in new business ventures because there's a good possibility of getting a good upside, a good return on investment above what the market would normally dictate if it were a loan. So just keep this in mind. The things I'm not going to speak about today, but that are also crucial, is remember shares, because now we're speaking about shares. This capital contribution, if you're running it in a company, would normally mean that you've got two shareholders in this company. Remember, there's no defined rule as to how these percentages need to be divvied up. So it can be 50-50, it can be 60-40, it can be whatever you want. Keep in mind the following. Just because a person puts in 100% of the capital required to buy a property doesn't entitle them to 100% of the shares. In fact, we've done deals where the person putting in all the capital for a deal only received 33% shares simply because the amount of effort that went into finding the deal and operating the business, not just property investment, this was a business. There were operational requirements to it. And that expertise was actually worth 67% versus just the 33% for standing capital, which the person was going to be paid back anyway. And another little thing to remember, And we see this very often. Let me first speak about loans, and then I'll come back to this point where there's this kind of hybrid between a loan and a share. Now, loans, debt. What's debt? Now, debt is a contractual obligation. Somebody gives you money, you're obligated to pay this money back, right? Now, this is contractual. There is no upside downside. You're obligated to pay the money back. If your business goes bad, you're obligated to pay the money back. If your business is doing fantastic, you still got to pay the money back. The good news there is that you've got a lot of money left over after you pay it back. So you get all the upside, but you also carry all the downside. So debt is good, but debt has to be managed, because if you take on debt, you have to pay the debt back. And the trick, ladies and gentlemen, is that people giving you money aren't going to do it knowing that they run a risk of not being paid back. So it's not like you can simply go, I'll open a company and I'll go get money and borrow it. And if things go wrong, I'll just liquidate the company and it's all good. No. See, credit providers, whether it's registered credit providers, whether it's private debt, doesn't matter who it is. Anyone that is going to give you money as a loan wants some form of security that they are going to receive their money back. So what is security? Comes in many shapes and forms. Most typically, if it's property investments, it would be a mortgage bond. What's a mortgage bond? Basically, first dibs at the property. Anything goes wrong, you fail to pay the person back. That guy, that creditor, has first dibs on the property, meaning they can go and force the seller of the property, get the proceeds, and cover their debt. What are other forms of security? Suretyships. We've spoken about suretyships a million times on the show with respect to lease agreements. What is that? It's a suretyship. You being held personally liable for the debt of whatever company you're using, and meaning that if something goes wrong and that company does not repay the loan, sorry, unfortunately, they're coming after you. And we've had examples of this that turned really, really bad, where people bought high-end properties with a business concept. And unfortunately, we've warned people about this before, high-end properties carry massive risks when it comes to rental collection, because they're so expensive that it's difficult for you as an owner to cover. And if there's simply one default and this rent of 50,000 Rand a month doesn't come in, that's 50,000 Rand that needs to come out of your pocket until you're able to evict this tenant. So it's very, very high risk. And in these cases, they actually use their trading companies, their successful businesses, to stand in as surety for this debt. And what happened at the end? Unfortunately, when the bank foreclosed, it didn't just foreclose and sell the property, but it went after the trading companies and went after its directors in their personal name. So please be very, very careful. Debt is risky. You don't just want to enter into debt not knowing whether you're going to be able to pay it back or not. But it is a good form of funding. And ideally, you'd actually want to take debt out only in future when your company is doing really well, and you've built up a reserve and you know that you can manage it, and now you start taking on debt to build your company more and more. That would be the ideal solution. But obviously we live in a different world. Home loans people take out from the beginning, and there's nothing wrong with that, but just understand the different risk components. If it's a high risk business, be very careful in taking debt out at the beginning, rather than have a partner that's willing to share in the downside, right? So now we have debt, we have equity. We explained, gave some examples of what type of security lenders are looking for. There's many others, but those are the most common, especially in the property space. Now, certain little things that we need to understand. So first of all, a capital contribution. What happens in South Africa quite a lot, and this is just a distinction, we speak about shareholders with loan accounts. Now, please don't confuse the two, because now you're going, wait, it's shareholder, but it's a debt. Oh, that's very confusing. Yes. So what happens is a lot of shareholders want to get their loan repaid to them, and they want repayment terms, and they want to charge interest on their loan. So what they sometimes do is everyone contributes 1 Rand towards the company. Everyone gets whatever, 50-50 shares. But now the capital contribution isn't done as a buy-in for shares, it's done as a loan. Now, this is done so that people can charge interest on this loan and they can get it repaid. More often than not, this loan isn't always secured, especially against the other shareholder. It's simply against the company. So this person gets first dibs to get the money paid back. First dibs on if the property gets sold, they get their loan repaid, but they still technically share the downside, because if the business doesn't do well, they don't get any money, and they're aware of that. So it is like a capital contribution, but it's kind of like a little hybrid model. Another thing to also bear in mind, some debt comes at a cost where the lenders take some form of share security, and this is one of those examples of securities. So they actually become a shareholder, right? But they become a shareholder with some kind of preference right. So they get a super strong right to vote against certain things or to veto certain decisions. So also keep that in mind. A person lending you money can also become a shareholder where their share gets triggered if something goes wrong and you start defaulting, and now they can exercise those shares to close the company, liquidate it, you name it, right? So that's also another example. Now, the idea behind having this financing optimization is being able to run your business and gain a track record that's so good that eventually people want to give you money. Remember that old adage that you only get money if you're making money. So the people that actually need it never get it, right? And the people that have enough of it will actually get it. Now, here's a business. Want that. You want to have enough of it because you want more in order to be able to build more. The more money you have, the more money you're going to make. So that is the goal. And as you get through this financial restructuring model, you start realizing that you go from simple conversations over, hi, I want to buy a property. Please loan me money. Thank you so much. I'm going to repay you back. To more complex financial models, where some banks and financial institutions, for example, ensure that you sign their MOI that has certain administrative policies in it, or have preference shares that are allocated to them, or they fund on a group level and they fund different companies under this group, and assets are kept in a certain place, and like the trading company in a different place. So it gets very complicated, where the banks, for example, will look overall at a company's performance across several different businesses and will be willing to grant finance for the purchase of a property, but by using as security the income that's coming in through the trading company. So that's kind of where you want to get to further on in your journey. So the structuring component is important, because if you don't use the right companies and the right vehicles, and you have these things stuck in your personal name, guess what's going to happen? No one's going to want to give you money. And that's the truth, right? People want properly run businesses. And unfortunately, businesses aren't intended to be run in your personal name. And given in mind all the tax downsides sometimes on running a business in your personal name, you truly want to make sure that you optimize it so that people will look at you and it will be appealing for them to want to give you money, because they see the possibility that they're going to make money back.